Welcome back, everyone, to another episode of the Level Up REI podcast. Your host, Lisa Hilton. Today, I have on the podcast Mark Shuler. He is a licensed architect in the state of Washington and Texas with more than 35 years of professional experience as an architect, engineer, business owner, and real estate investor. He's the principal of Shuler Architecture and has amassed a portfolio of over 500 projects in more than 15 states. He's also the president of SGRE Investments, and he pursues value add opportunities that leverage his professional background and capitalize on his skill sets as an architect and real estate advisor. So since 2015, Mark and his partners have amassed a portfolio of 2,000 units in the Puget Sound and Texas with an acquisition basis of $300 million. They have created significant returns and tens of millions of wealth for more than 400 investors and continue to acquire several assets a year. Thank you for coming on the show, Mark. I really appreciate it.
Sure. My pleasure. Thanks for having me.
Yes. And I'm so glad in your bio, you mentioned like since 2015, you have been doing this. So this is not, you didn't just roll out of bed yesterday and just got started. So yeah, so coming out of the gate really hot and heavy, we are in a very tumultuous point in our economy right now. We have, rising interest rates going on. You have inflation. Many investors are skittish about continuing to invest in multifamily investments. So to kick things off right out the gate, from your perspective as an active operator in the space, can you talk about, whether you're still investing and what that looks like for you today?
Yeah, we are at an inflection point, and we're maybe kind of going to roll into a recession, maybe not. But the Fed has to do its job and get interest rates not interest rates, but inflation under control. And they can only do that, one of the main tools they have to do that is to raise interest rates, which is a direct impact on my bottom line. It also has a really direct impact on valuations. And so, we were finding prior to sort of this year that valuations were already getting fairly unrealistic. Owners were just wanting skyball, prices for their assets. And we're still able to make the economics work on deals, but it was getting more and more challenging. We were underwriting legitimately twice as many deals as we did, the prior 3 years to find the one that we would pursue. Now we're underwriting 4 or 5 times as many, and none of the economics are working. Between rising interest rates and owners not wanting to come down, sellers don't realize that their assets are worth 15% less than what they were just 6 months ago. That's the reality of rising interest rates. I have to bring, a lot more cash to the table. I've got a lower leverage point now. The economics are much different than they were 6 months ago. So we're not finding, that deals work for us right now. And so, like it or not, we're sitting on the sidelines. That said, if we find a deal that works, we know we have stress tested it and we know it will pay returns. So if we put it out, investors should definitely jump on it because you're not going to get any returns in the stock market anytime soon. That's for sure. And the way we do our deals, I personally feel we have less volatility and less risk than, securities or equities in the stock market or anything like that. I mean, it's not Bitcoin, thank
right.
God.
Yeah. It's not disappearing tomorrow.
Yeah. So, it's just the way we financially engineer the upside on our deals that provides the real security and lowered risk profile that for our investors than you'll see in other asset classes.
Got it.
I would say it's still if you can find a deal, it's still well worth pursuing. It's just challenging to find a deal right now.
Can you talk a little bit about the stress testing? Because by and large, there's a lot of deals that people are raising capital for right now in the multifamily space. As investors, I am an investor myself, and I'm constantly looking at these multifamily deals and trying to determine, hey, is this a good deal for me to be investing capital in? So I'm sure that many investors have that same question now. And when you talk about stress testing, I'm curious about either stress testing or your just perspective as an operator, advice you would give to people who are passively investing in deals.
Yeah, it's a great question. That is the question right there. The first thing I usually counsel is, look at the operator who's putting, the sponsor of this deal, and are they an operator or are they hiring third-party companies to do everything? We're vertically integrated, and we're vertically integrated for a reason, is that we're trying to control all of our labor. Before we got on this, we were talking about the challenges with the labor.
Mhm.
It is rampant in what I do for a living. So we have hired all of the labor and brought them in-house. So we formed a asset management company, and we do all our own contracting. And so when we have a problem on an asset, I mean, we own so many assets around Houston in particular that stuff crops up all the time. We have the in-house horsepower to be able to point and shoot. Said, we're going to pull you off this job, and at 8 o'clock tomorrow morning, I want you on this job, and I want you to fix this, toilet or whatever. Other operators, if they're going third party, you might have a week to 2 week delay there if you're lucky,
Mhm.
getting somebody to show up at a unit to fix a leaky toilet. The other reason why we have all of the labor in-house is we're able to control our cost structure, the expense side of the ledger on our deals. I mean, we are legitimately turning and managing these assets for half of what anybody else can. I mean, and it's all because we have all the labor in-house. We
Mhm.
pay a living wage, but we're not paying third-party wages, all the
Right.
profit that these third-party operators have. I mean, when you hire a third-party asset management company, they're going to make a profit. When you hire a contractor, there's generally a 20 to 30% profit line in there. So, by bringing all that expense in-house, not only have we eliminated that profit line,
Mhm.
but we're able to control the cost of the labor very effectively. Plus, we're able to get quality labor. So as time goes on, we're building, in the contracting end of things, a really solid core group of people who work for us that, they're rock solid turn guys, for instance,
Mhm.
and I just don't have any questions. I can just literally say, okay, go to this 1 bedroom unit on this property and put package A, B, or C in it. And, it just makes it a lot easier as an operator and a deal sponsor to be able to, ultimately what I'm trying to do is shove all of that to the bottom line, but also have a very predictable business model that I can then turn to my investors and say, I got this. I got this all
Right.
in control, and I've mitigated as much risk out of this as I can think of. Then we stress test the deal to make sure that the economics of the deal work out. So, in our underwriting, we empty, we figure that we have an economic vacancy of 30 to 35% the first 2 years of any deal, just to make sure that, because as I renovate units, I'm going to have vacancies, right? And the
Mhm.
body can't live there while I'm renovating it.
Right.
I've seen so many operators pretend that they're going to have a 7 or 8% vacancy rate as they're renovating the asset. And it's like, how the hell do you do that? That's impossible. You
Mhm.
can't do it. So all of a sudden they've got, and they don't understand that because they're not experienced operators. So I guess the point I'm trying to make is if you're looking at deals, you should be looking at the experience of the sponsor. Are
Mhm.
they experienced, savvy sponsors? Do they have an operations component to their business model, or are they doing third party on everything? They're third party on everything. I already know they're 15% less profitable than me, probably more. And then are they, I mean, the only way you make money in this business, Lisa,
You're right.
is through operations.
Mhm.
You make it two ways, actually. You make it on the buy, and you make it through operations. So if you buy right, you can still screw up a deal by massively mismanaging. So we buy right, and we make sure we manage it very, very effectively. That is who you should be looking for as an operator and as a deal sponsor. I mean, there are some other things, metrics in the underwriting that I generally point to
Mhm.
when people ask me this question a lot. And So the vacancy rate in the first couple of years, if it's a big value add deal. Another one is check their debt assumptions, check the leverage. We do the classic bridge to perm model, so we're getting a little higher leverage on the bridge product, but even then, I don't want to take it way out there. I've never done a 90% levered deal. That's just insane to me. So, the bridge product, you can average between 75 and 80% and be okay. Because you're going to get enough pop on the back
Right.
after you've done your value add. You'll have plenty of cash there to be able to pull out, hand off to your investors. If you over leverage it, you're not going to have any cash. And so you're robbing yourself, in my mind, of a marketing opportunity with your investors. It's like you're not going to have the money to give them at that value add or that refi event.
Mm-hmm.
And believe me, they're wanting it.
Right.
You may not think that, but they do. So it's just savvy business sensibility of how you go about and go through a deal.
Mm-hmm.
One of the big ones that I think a lot of sponsors cheat on is the exit cap rate. And so I have never underwritten a deal where I assumed I was going to have a lower cap rate
Mm-hmm.
than when I went in. It's just an automatic. It's at least half a point higher on my exit than when I go in. And I do that specifically for times like this that we're in. You
Yeah.
know, you don't know. You don't know what the economy is going to do. I mean, we've got a hot war in Russia. Who knew 2 years ago we were going to have a hot war, in Ukraine?
Right.
Who knew we were going to have a hot war in Europe? What has that done to the world economy?
Mm-hmm.
Supply chain is all screwed up, and that's where a lot of inflation is occurring from. So don't kid yourself. Stuff happens. I've
Right.
been through 4 or 5 recessions now, and no one ever banks on a recession. It's the smart people sort of plan for it. And look, if it doesn't happen and you exit and you're 3/4 of a point lower than your exit assumption in your underwriting, you're a hero.
Right.
You look like a hero and a rock star. So, but I see too many underwriters who assume they're going to have a quarter to a half point lower on the exit than going in. Everybody thinks we're going to be going down and to the right on these cap rates. And I can
Right.
assure you, it's not like that. Cap rates are a sine wave. What goes down has to go up. And so a lot of these sellers who are unwilling to sell at today's prices, a good percentage of them made that mistake. And now they can't sell in the new reality. So they're kind of hanging out, sweating bullets, or I don't know what they're doing, but they're waiting for somebody to come along and overpay for the asset. And we're not going to do it. I can wait longer than they can.
100%. So a couple things in your question here. Well, actually, one thing before I go to the value add and the refi, because you play in Texas, and I know this, so I should probably ask you the question so people know as well. What market do you focus on playing in?
Do you want the PC version or can I be straight up?
Please be straight up.
I only do business in red states.
There you go.
And you may ask why. Well, I live in the bluest of the blue,
Mm-hmm.
where we have soft rent control year round now.
Mm-hmm.
We still have eviction moratoriums here. They tried to continue the eviction moratoriums out of the pandemic until Seattle City Council almost got voted out of office, and they kind of snapped out of it. So what they've done now is they have, we believe it or not, the only place in the country where we have a winter month eviction moratorium. Like from October until end of February, it's an automatic. You just can't evict people.
Wow.
And if you don't think my tenants are gaming the system on that one, I got swampland in Florida, I can sell you. We also have a school year eviction moratorium that goes from September to June. So 9 months of the year, and granted, that one is only applies to renters with children,
Right.
which I have a few. And I'd be much more inclined to like work something out with that renter than evict them. But I have a very heavy-handed government here. I mean, they passed 38 pieces of renter protection legislation in the last 5 years.
Wow.
And I and a lot of operators and developers here have had enough. And so what is going on in this market is you're finding that housing here is being corporatized.
Mm.
So everything that Seattle City Council is ostensibly trying to prevent from happening is going to happen. Housing is a free market phenomenon. It is
Right.
very, very, very sensitive to free market forces. And there's always unintended consequences to kind of meddling with the free market.
Right.
And it's one thing to sit in an office in the 23rd floor of the city administration building thinking big thoughts and how you're going to save humanity from itself. It's another thing to be out in the market taking risks, trying to make this happen. And so I've just decided I can't do business here. So, or anywhere on the West Coast for that matter.
Yeah,
So,
totally.
so I look for markets where the playing field's a little more level, and it's just not as adversarial.
Sure.
I believe that there's some protections that need to be being put in place, and there's a function for that, for government in that marketplace. I
Right.
do believe that. I'm a practicing architect. I deal with government all day long.
Hmm.
Building and life safety codes are a thing, and they're there for a reason. And if they weren't there, people would die in these buildings. I know that. I've had 3 fires in my buildings in the last 24 months.
Mm.
Fires are a big deal in multifamily. So I'm not, a flaming libertarian by any stretch of the imagination. But the pendulum swings left, the pendulum swings
Right.
right, and so I just kind of wanted to stand pat in the middle so I can do business. I just have to look for opportunities and environments where I think that's going to be the case. And
100%.
yeah,
Yeah.
yeah,
So where I was sort of going with this is I know that you play a lot in the Houston area.
I do.
And as we think about underwriting, 3 things that 2 of which you brought up, which is value add and refi, and then the third is taxes.
Oh yeah,
So I wanted to talk a little bit about, like, could you touch on a bit about taxes? Because I
sure.
think that in underwriting specifically for the market of Houston and just the Texas markets in general, like they have investors need to be thinking about like how the operator is dealing with projecting taxes in the underwriting.
Yeah, it's yet another really insightful question, Lisa. So look, government is populated with personalities, and so human nature is just human nature. I sort of accept that. And
Right.
what's going to happen in the assessor's office in every jurisdiction in the country is, government ultimately has to pay its bills. And much of the income that governments generate across this country is based on real estate taxation. It is only in government's best interest to continue raising the valuation of assets so that they can continue to pay for all the things that they have to pay for.
Right.
Problem is, we just went through a once in a century economic event, and we had all these eviction moratoriums, and landlords were losing cash and were financing tenants to live in their units for free forever. So income off of a lot of every asset nationwide was way down. Governments didn't recognize that, and they continued to raise taxes as if the valuation of these assets continues to go north.
Mm.
Well, the basic valuation formula is, net operating income divided by the cap rate in the marketplace. So if the NOI has gone down, the valuation has to go down, but government is pretending that it continues to go up.
Hmm.
So you're getting squeezed by these eviction moratoriums on the one end and increased taxation on the other. So your expense, you're getting hammered on your income and hammered on your expense side of the ledger. That's why deals don't work right now. So I know what we do. We have an attorney on permanent retainer, and we can test every deal every year. We go to the assessor's office and we can test the valuation. It's like I'm sorry, I can prove it. Here's the numbers. and so we try to keep the tax side of the ledger, we work really hard to keep that in check, to make sure that we are not overpaying. And so if you go through the assessor rolls on any one of our deals, you'll see it's contested every year.
Mm.
You know, I think as you underwrite a deal, you need to go in and figure out what the mill rate is for that jurisdiction, and just, don't be too overly optimistic about that in terms of, yeah, but they're only going to charge me this much, not this much. Well, no, they're going to charge you this much. They're going to try to charge you that much. And I have empirical proof from the last 30 months. That's what happens.
Mm.
So,
And
just
then
be
with the
aware of it.
contesting, are you guys able to really win a lot of that? Like
Oh, win
at
them
least
all.
bring it down?
Oh,
Okay.
yeah. Yeah, but it's expensive. Gotta spend money to make money, right? So,
Mm.
so
Got
now
it.
your legal fees go way up. This is what I'm talking about. There are unintended consequences when you meddle with the free market. There are unintended consequences. It just becomes really, and so ultimately you have to budget correctly as you're underwriting the deal for either the
Right.
taxation or the legal fees or both.
Sure.
And that just comes through experience.
Of course. So then the next item that you brought up was refinancing. So do you typically project, put in your underwriting that you are going to be refinancing? And then what about if the refinance doesn't actually happen, especially in a situation like now where rates are continuing to increase? So people are probably not going to refi because now you're going to have a higher payment than what you currently have.
Right. We're in that scenario in one of our deals.
Mhm.
And, so the beauty of the free market is so what happened in the refi market with the bridge lenders is the bridge lenders miraculously all lost their backbone at, the entry door. And so
Mhm.
they all chickened out and they all pulled out of the market or whatever. I've been doing this long enough. I know that I'll wait 4 months and there'll be new players entering the market because they profit incentive is there and they sense an opportunity. So I just waited, and that's exactly what happened.
Mm.
So, now we're talking to lots of other lenders and we're going to get it done. We'll get it done. And, it wasn't as good as it was 2 years ago when we were refining our deals, but, it's still much better than what we're doing now. And we're ready. We've already done all of the the rehab on this one deal.
Right.
And, the cash flow is way up. I mean, the good news is the longer it takes us to refi, the more my NOI grows. And so I'm just getting a higher and higher valuation on this thing. As markets rebound, like Houston rebounded in no time.
Right.
Well, all that increased competition for assets in Houston has driven down cap rates. So my NOI, so the exact opposite of what happened in the beginning of the pandemic is happening on the back end. My NOI is going up. The cap rates are now drilling down again, and you're seeing these higher and higher valuations. So, you see a lender that comes into the marketplace after the big boys left, all the Wall
Mhm.
Street hedge funds got out of it, and they're licking their chops because, I mean, we're sitting on a ton of equity in this deal, and they're just leaping over the desk to kind of refi it. Now you got to kind of quibble over the loan rates and everything else they want. And
Mhm.
that's just negotiation, but look, there are plenty of lenders out there that we're still talking to. I mean, what we're doing now is instead of going through, some of the bigger players,
Mhm.
and then we typically utilize a broker to go
Mhm.
to get to those players.
Mhm.
We're going direct to some of the bigger banks like Wells Fargo and US Banker. They're getting in the game and they're not charging any fees. They just want to make cash flow. It's
Mhm.
like, holy moly. So now we're not paying a refi fee or a brokerage fee. That's 2 points on a $70 million deal. That's over $1 million that I get to put, into the kitty, and I get to pay it and distribute to my investors. It all works out. Capitalism, aspects of capitalism are a beautiful thing, and
But I think what's key to note is that, you would want, as an investor investing in these deals and seeing refis in the underwriting, like in the pro formas,
yeah,
you want to know you want to either you're going to redo the underwriting yourself or have these questions with the sponsor that you trust, that
Right.
if they were unable to do a refi, that they still would be able to cash flow, like they would still be able to, you know,
We're cash flowing just fine on this deal. The problem is when you go in on a bridge product,
there's a timeline.
there's a short-term loan on or a time frame on that note.
Hmm.
Your worst case scenario is that bridge lender has, that's where this gets fun. You go stare him in the eyeballs. Is like, dude, what do you want me to do? See who's going to blink first.
Have you ever had any situations where that has happened?
Oh yeah,
Really?
oh yeah, yeah.
And like, has this happened multiple times? Like, what ended up
Nah, it doesn't
happening?
happen very often, but it's going to happen more and more. You're going to see a lot of that going forward. You're going to see a ton of it
Yeah.
because these operators, they're upside down on their cash flow. A lot of them are going to be upside down. And the bridge lender, I mean, if they can't refi out of the deal, the last thing a bridge lender wants to do is take an asset back. They have zero interest in doing that. So they may have to turn that into a permanent product of some sort. And so they'll have to negotiate, terms for a perm, and then they'll sell it off in the secondary market and they'll get out from underneath it that way.
Mm,
It's, once you understand how capital markets work, I mean, there are workouts that are done all the time. It's not what you
sure.
want to bank on going in. You don't want to bank on that worst case scenario. I mean, everybody wants to bank on a refi after like 24 or 30 months and, cash out, hand money to the investors. That's the perfect scenario. That ain't going to happen here in the
Sure.
next 6 to 9 to 12 months. That's not what you're going to see.
Yeah, got it. And then connected to the refi is the whole value add. And I know personally that value add, the investing value add model is definitely powerful, but I think it's the way in which you execute it is many times you will actually deal primarily in the class C asset class of multifamily
Yeah.
assets. And there are real realities of playing in that space when it comes to value add. So, so from my perspective, the returns are higher, but the risks are also higher
That's
as
right.
well. So, can you talk a little bit about that in terms of from an investor's point of view to get comfortable that, hey, listen, you're going to get more, you have the potential to get more return here, but you are also going into a more aggressive play, I think.
Again, very insightful question. So your listeners ought to understand that there are classes of assets out there. Let's start with the basics. There's A class, B class, C class, and I've done legitimate D and F class buildings.
Wow. You have
Oh
DNF
yeah,
as
oh
well?
yeah, yeah.
Oh, wow. Got
Oh
it.
yeah. And so what you have to do is size up the opportunity. But your question is exactly right. With greater reward comes greater risk.
Mhm,
And so you have to evaluate your risk tolerance as an investor
mhm.
and have a really honest conversation with yourself. Yeah, I want to make all this money. I want to make 23% IRR and have an 8 to 10 pref every year. And it's like, well, okay, but are you willing to like invest in a riskier proposition? In a C class deal, you're dealing with a demographic
Mhm,
that is just more management intensive. That's the reality of it,
mhm,
you know. Most folks who can afford to invest in these deals are solidly middle class or upper middle class. That is a world that's removed from their reality.
mhm.
And, first of all, I would counsel don't judge it. That is the world we live in. I was born a lower middle class kid in Detroit and, we rented houses forever. And, you know, no one ever labeled me an athlete and I don't have movie star good looks. So I played the hand I was dealt. I was just always
Right.
one of the smarter guys in the room. And, I've parlayed that into a solid middle class lifestyle for myself. Woohoo, good on me. But that's the reality when you go into the value add game is you're dealing with a lot of immigrant population, for instance. I mean,
Mhm,
I had one deal here in Seattle in a community where the community's high school is year after year after year voted the most diverse high school in the country, speaks 57 unique languages. And it's down near our international airport. So a lot of these folks are literally coming out of refugee camps from North Africa.
Mhm.
I've had investors or tenants go in there and they're can't figure out how to use a stove. They want to start a fire in the middle of the fire in the living room. And I have like, and it's like, no, 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 that's not how we do it here in this country. So, but you know, the diet, I mean, little things like their diet is primarily, based on boiling water. They boil a lot of water. Well, water and buildings don't mix. And so you're now developing mold problems throughout all these units. So you have to be very attentive. That's the management problem. You got to make sure you're on the mold. You got to make sure all of your bath fans work. You got to make sure that your dryer vents are not clogged up.
Mm.
So you've just got to be able to connect the dots between your demographic and what you're going to have to do as an operator. Again, that comes with experience. And so, but I want to say it again, don't judge it. It's just that's the business. I actually enjoy it. I like meeting people. I like new ideas.
Yeah.
I will talk to any of my tenants just because I find it fascinating. And I can be a chatterbox. So,
And then this, brings me, I think one of the things that I'll also connect to that is the importance of what you were saying earlier, like having that vertically integrated property management.
yeah,
Because, like, if you, that property management, they're going to be the face, they're the front line of sort of dealing with these things and sort of knowing like what to do to preemptively avoid things going the wrong way before it's
you
too
know,
late.
when you get a rock star property manager, you hang on to them,
Mm,
and for a lot of reasons, but I think that's one of the harder jobs in the whole
in the
organization.
business, yeah, 100%.
And some of them are as gracious as you can imagine. I mean, they got to be tough as nails, but you got, the really good ones have a way of comporting themselves with a real grace that I'm just always in awe of. And so we make sure, in our operation, we recognize everybody. So we have like the employee of the month and,
Hmm.
all sorts of things that we do, through social media to promote. Sure, there's some self-interest there, but also to kind of like really recognize our employees. I mean,
Right.
and so I mean, not only are you dealing with your tenants, you're dealing with your employees. And so you've got to manage all of this. Labor's, a real thing, and you got to manage it effectively. You don't want to take anybody for granted. That's, I guess, the main walk away with that one.
Got it. Perfect. And then my last question here is, as investors look at deals, what is more important, assessing the deal or assessing the deal sponsor?
I honestly don't know. I
Hmm.
assess them both very intensely, personally.
Hmm.
I mean, I have a little bit of money I have to place in a deal, and I have the same problem as anybody else. And it's like, who do I want to invest with? And
Hmm.
I personally, I mean, for me, checking out the economics of a deal is pretty second nature. I live, eat, sleep, breathe, dream numbers.
Right.
This is all a math problem. It's all it is.
Right.
So you can vet that out probably in an hour or two. I mean, generally speaking, I can do it in about 10 minutes because I just kind of look at it high level and it's like, well, that doesn't work, that doesn't work. And so there are 4 or 5 things. If 3 or 4 of them don't work, the deal doesn't work. So I just move on. But from there, what I'll do is I'll start like translating it to like, okay, why did that sponsor, blow up that deal and not catch it? And it's going to be one of two things. Are they got something to hide? Or
Mm.
are they just ignorant? They don't know what they're doing. And so, and I try not to bust anybody's chops too hard, but I do look at people's experience level.
Right.
I think it's important to, and I think too many people read these bright, shiny OMs that come pouring out of everywhere and, want to believe that they can get those returns. And I think a lot of them are, not as, the reality is not as nice as you know, the dream that they're proposing. And
Right.
so you have to be skeptical, trust but verify. Yeah.
100%. And then question for you, like what about when you're presented deals outside of multifamily? Because multifamily is your bread and butter.
Yeah.
But say, someone brings you mobile home parks or self-storage. Like, you know, What's your approach there? Or maybe you don't have an approach because you're not interested in those kinds of asset classes.
Uh, Lisa, I've been a housing guy for 40 years.
Yeah.
I wrote my essay to architecture school about affordable housing. That was 40
Ah.
years ago. So for me, it's always been a passion to do what I'm doing. Like I had a big ass detour as an architect for a lot of years, but I've always wanted to do exactly what I'm doing.
Gotcha.
Mobile home parks, I mean, they're an interesting model. One interesting sidebar to that is most zoning codes throughout the country have outlawed them.
Mhm.
And we can get into a long dissertation about white middle class values and those values populating, zoning codes throughout the country.
Mhm.
Basically, back in the day, we used to call that redlining.
Mhm.
They've been regulated out of existence.
Mhm.
Wonder why that is. And so the ones that are out there that are trading are ancient. And so a lot of the utilities need serious work, like the water and sewer lines, and a lot of these parks are just atrocious. There are breaks
Right.
everywhere. Your water bill, water, you pay for the water coming in and going out. So the water, utility, the water and sewer bill on these things is huge. So the first thing you're doing is run around the park looking for the leaks. I looked at one mobile home park deal, about 5 years ago, and it was on a septic system that had completely failed, and the
Mm.
effluent was coming. It blew the top off the tank, and it was like sheeting across the lot. You had raw sewage sheeting across the lot. Now you have a public health disaster. So you want to, if you want to look at that, these types of deals, really you got to look at the age of the park. A lot of them were built in the 50s and 60s.
Mhm.
You want to look at the percentage of park owned homes. A lot of mom and pop operators have the stupid belief that they want to own the homes and then rent them like apartments. That is not the model to be using in these deals, in my opinion.
Mhm.
You don't want ancient homes there that are falling apart and dragging down the whole profile of your park. So, um, I've also found that park operators tend to be mom and pop, so they're not a very sophisticated crowd when it comes to transactions. I don't know. There were just a lot of headaches involved with it. I looked at a couple. I actually made an offer on one back in the day, and everything I was telling you came true. Then
Right.
the husband inked the deal, and the wife like screamed at him and said, "Why did you? We're not selling this." And they just kind of walked away from the deal. And I could have sued him for non-performance, and I was just like, you know what? This is like a no-win. I'm never going to win on this one. So I just
Right.
walked away from the deal. And it's like, you know what? That's the last time I'm ever going to look at a mobile home park deal. I know people who,
Yeah,
they
they
love it.
love it.
They
Yeah.
love it. The profit margin is pretty high on them, but they're management intensive. And I don't get to do the development activity. I can't do the forced appreciation model that I like to
Mhm.
do.
Mhm.
I like to build. All right. And so I mean, I guess we should talk about what value add really is.
Yeah, we should
You know,
before we wrap
value
up here.
add,
Yeah.
value add means you are forcing appreciation.
Right.
You are trying to increase the value of the asset and throwing, $3,500 a door at, your apartments in a 200 unit deal. That's maintenance. That's not value add. That is not value add. You have to do significant upgrades to these units in order to command higher rents in the marketplace. And so that entails an entire operation, entails supply chain, entails us having drivers in a warehouse where we store all this stuff because we buy all our goods overseas and have them shipped to Houston, and then we haul them from the port of Houston over to our warehouse. And then as we need them on our projects, we haul them out to the projects.
Right.
So, it is a much bigger business model than a lot of people just getting into business realize.
Mhm.
But the only way to force appreciation is to do a massive makeover on these units. That's why I buy these C-class deals, because they really need work. And when we're done
And
with them,
the key aspect of that makeover are what? Appliances, changing out of
Everything,
appliances,
everything.
cabinets,
We don't
flooring.
change, we do the flooring. So I hate carpet. So we do vinyl plank, luxury vinyl plank flooring throughout all of our units. I have laid hundreds of thousands of square feet of vinyl plank flooring.
Mhm,
Um, we do all new base trim, we do all new paint, new light fixtures, new appliances, new
mhm.
plumbing fixtures. We typically leave the existing boxes on the wall, but maybe we'll swap out the doors, at least the hardware.
Right.
But they're all sanded, smooth, and painted, and they look great. We do granite countertops in all our deals,
Gotcha.
just
And then
because
are
it
you adding washers and dryers too?
depends on the deal and the location.
And I would assume that's true for the granite too.
No, we granite's a standard for us.
Okay,
Yeah.
got it.
And think about what I just described as a work scope to you,
Hmm.
and then visualize a C-class deal. So we're by that value add exercise, I mean, we're spending 16, 18,000 a door. Our cost, and our cost is half of what anybody else can do this for, legitimately, maybe, 2/3. Nobody else is going to touch that for, I mean, I've gotten third-party bids for that scope of work, and it was $60,000 a door. It's like, you're smoking crack. I'm not going to pay you that. Get out of here. But for us to do it at 18 a door, it's going to legitimately take somebody else 35 to 40 a door to do that.
Got it.
But let me finish this point. What we then have at the end of the exercise,
Hmm.
the best looking product in the market. And so what we're commanding for rents is market plus 10%. So we're now getting the premium in the marketplace, and we're setting the standard, the benchmark for the rest of the marketplace around us. So that's where the value add comes from. The NOI just skyballs from there. You get more than 50 or 60% of the units done, you're making a lot of money. The profits are, the cash flow is just huge because you've taken care of all the problems. You've turned a lot of tenants out.
Right.
What people don't, the first thing people think is, oh, well, your tenants are going to move out because their rents are going up. Not the case. 50% of our tenants are releases from within the asset,
Mm.
where the people are so excited to finally be living in a really classy unit. I'd walk my deals, had tenants come up to me and say, when are you going to get to my unit? I can't wait. And then the asset manager will tell me they are so excited that you're doing all this work.
Wow.
This is why I do what I do.
Yeah. Yeah.
It's the
Yeah.
first
You're
time, and
improving people's lives.
that's exactly right. And it's the first time in their life that these folks are living in a nice, home. So,
Yeah.
everybody should have the opportunity to have their head hit the pillow in a dignified,
Place. Yeah.
housing situation every night.
Yeah. 100%. Wow, this was so good. Thank you so much, Mark, for coming on. I really appreciate it. We could talk for on and on and on because
I
you have
could.
so much experience doing all this stuff, and your passion about it, is what makes you take on projects and that you learn so deeply from, but are also very challenging. So, really, really excited to have you on. If my listeners want to learn more about you and your offerings, where's the best place they can go to learn more?
You can go to my website, SGRE Investments. That's plural, SGREinvestments.com. You can just hit me up through emails, usually the best. Mark at SGREinvestments.com.
Got it. Perfect. Thank you, Mark. It was a pleasure having you on.